Great pleasure to be here. It's been a phenomenal couple of years for the company, and great pleasure to really present some of the recent results across multiple work streams, but also share what's ahead in terms of key milestones for this year. Share on the screen. Okay, standard disclaimer. Please feel free to read that at your leisure. So really, the company on a page, and this is a really important slide. As I said, the company has only been listed for a couple of years now, in May of 2021. And what we've delivered in that 2 years is quite an outstanding result by way of a JORC compliant resource across two projects located in the world's best mining jurisdictions of the Pilbara and the Eastern Goldfields. So currently, the company is sitting at a 54 million tonne resource at about 1.1%. And importantly, there's plenty more to come in terms of resource upside. Having two projects in the world's best mining jurisdiction also gives us great development optionality. And given there are no royalties across our projects, we own both projects wholly, and most of our offtake is uncontracted. That gives us fantastic optionality around partnering as well. And there's very strong interest in the company from a range of investors, but also downstream partners on a global basis. And I'll talk a little bit about that later. Getting to JORC compliance in the mining industry is not easy. You need to do a significant amount of drilling, and we've just wrapped up a 60,000 metre drill campaign at our Manna Lithium Project. So we've now completed over 100,000 metres of drilling at Manna. And that's important because it's given us an incredible geological understanding of the asset. More than 50% of the total MRE is in the indicated classification, and we expect that to improve with further drill campaigns. But importantly, the asset is open both to the north and the south and at depth. So in terms of resource growth, we expect more to come in terms of that resource. And Western Australia is arguably the world's greatest mining jurisdiction. We have fantastic processes in place here, great skill sets across multiple disciplines, commercial, technical, operational. And it really gives us a great opportunity to take our projects forward at an incredibly fast pace. And hard rock lithium, and certainly in my experience, I've been in the sector 14 years, is the fastest way to develop lithium units into the market. We've got some great partners on our register. Strategic partners are important. We've got two great partners in Mineral Resources and CAMAX. CAMAX is one of the largest lithium hydroxide producers in China. They control more than 130,000 tonnes of lithium hydroxide conversion capacity. So this gives us two things. One, a great understanding of the requirements around the spodumene concentrate to be delivered to market, but also some fantastic insights into what's happening in the industry. And China is still leading the industry. We're well capitalised, 36 million in the bank as of 31 December. Gives us a great platform for growth going forward. We're well protected. We have got a disciplined approach to the way we spend this year in light of the current market. But we expect that balance sheet to push us well into next year. So when that market rebounds again, we'll be in a wonderful position to take our project forward. We do have a lot of experience through the business, both at the board level and management level. I'll touch on that shortly. And I've got some really good insights through my role on the London Metal Exchange Lithium and Cobalt Committee. It's a role I've had for more than 4.5 years. And as I mentioned earlier, always got an eye on growth. We've had a number of approaches, and certainly there will be some wonderful opportunities throughout the course of this year as companies pull back. Their balance sheets are stretched, so we're always on the lookout for growing our business, growing our resources as well. And I think there will be some excellent opportunities for us. So just touching on the company, corporately, as I said, you've got our share price performance there from May 2021. Market cap currently sitting at around 136 million, share price around 50 cents. And it's a pretty tight register, 260 million shares on issue. As I said, strong cash position. We do also have a 10% equity position in another ASX listed company to the south of us. That's really a strategic acquisition, and there's currently about $3.6 million of stock valued under that acquisition. The register, as I mentioned, is tight. Two strategics taking close to 20%, including Mineral Resources. There's a couple of high net worth individuals sitting on the register. Board and management have got significant skin in the game, and certainly incentivized to see our projects progress and then the balance is a combination of retail and institutional investors. There's 6 companies currently covering the stock on an unpaid basis, so I do encourage you to reach out to those companies for further information. The board's a strong one. You know, we've assembled this board. There's 180 years of cumulative resources experience here in Western Australia. All of the board and directors are based locally here in Perth. Gives us a great optionality to meet regularly. It's a well-informed board and a curious board, and led by Jeff Jones as non-exec chair. And Greg's got more than 10 years operational experience, former MD at GR Engineering Services, another ASX-listed company, so knows how to build plants, and he's had some tremendous insights to us as a company as we progress through our DFS. Dr. Chen is one of the founders of the company, mining engineer by background. And again, as we progress through the DFS and we sharpen up our mine schedule and mine planning, Dr. Chen is providing great value there. And Hayley, commercial lawyer by trade, Hayley Lawrence, again, very curious. Hayley also leads our sustainability committee, and is adding, you know, tremendous rigor to the decision-making process and corporate governance throughout the business. Greg Leatherman doesn't need any introduction. Greg's a heavyweight in the West Australian mining industry, former 2IC at Fortescue Metal Group, and 20-odd years at Rio Tinto. So Greg's connections in the industry have been invaluable for us as we progress through and develop our projects. And then lastly, our co-sec, Kevin Hart, again, 30 plus years co-sec and CFO roles in ASX-listed companies. So Kevin, again, is providing tremendous input to the company. So strong board and well-positioned. We meet regularly. Importantly, the leadership team is, again, an equally strong one. We've got sort of 4 key pillars to the business. Matt Allen, who's joining the call today as CFO, and Matt's got some great experience, international experience that he brings to the company, well-versed in taking projects forward from conception all the way through the exploration development phase and ultimately into production. Dr. Tony Chamberlain, a metallurgist by training, again, leading our DFS and a number of our technical de-risking work streams. That's the second core pillar to the business. Exploration is a key focus of the company, of course, led by Logan Barber, who's made a number of very high-profile discoveries. He's handled most lithium in Western Australia. Previously spent some time at Mineral Resources at Wodgina. Drew out a number of lithium deposits, including our Marble Bar deposit. So Logan and his team are providing great insights and great value. And lastly, approvals. Approvals is essential to the success of any business. If you're looking to move into production, that's certainly something we have a high ambition to achieve. And Simon Corrigan is really leading our approvals team. So let's take a look at Manna. As I said earlier, it's 100% owned by the company. We acquired 100% ownership in October of 2022. Great jurisdiction. You know, this is the best type of lithium raw material for the battery industry. It's a spodumene bearing pegmatite. There are a lot of different types of lithium mineralization as it relates to hard rock. There's the petalite, a number of other lithium minerals, but we have quite a unique ore body that's super clean in terms of its gangue mineralization, but importantly, it's a spodumene bearing pegmatite, and it's a terrific starting position as a project. We've only spent 2 years drilling this resource, and we're already at a 36 million tonne resource, which is really based on the 2022 drill campaign and all the prior drilling that was done. That's at about a cumulative position of around 55,000 metres of drilling. Importantly, the 60,000 metre drill campaign, which completed in December of last year, is yet to be included in the mineral resource estimate. So I touched on that. 2022 was a big exploration campaign for us at Manna, 46,000 metres, 60,000 metres last year. So we are expecting an MRE update in Q2 of this year. We've undertaken a number of very significant drill campaigns at Manna, a combination of infill drilling and also extensional drilling, chasing the targets to the north and the extensions to the north and to the south, and of course at depth. And what we've found for the infill, we've had some terrifically high-grade, consistently high-grade mineralisation coming through on the assays, and we'll be bringing those results to market throughout the course of this quarter. Location is important. We've got an asset here in as I said earlier, one of the world's greatest mining jurisdictions, and not only the jurisdiction, but the infrastructure is critical. There are many projects located globally that on paper have got good resources, but the big challenge is going to be the infrastructure and getting those minerals to market. So as you can see here, our project located approximately 100 kilometres to the east of Kalgoorlie, one of the world's most historic mining towns. But with that history comes a lot of ancillary services that will benefit our project going forward. Labour, of course, consumables, spare parts. We do have an operational rail line, the Trans-Australian Rail Line, operating about 13 kilometres south of the pegmatite system. So that is absolutely some infrastructure that we'll look to utilise as part of our DFS. So we've got a number of logistics optimisation work streams ongoing, but we do anticipate using that rail line to get our product down to the Port of Esperance. We've got a very wide access road, 26 plus metres, that runs parallel to the Trans-Australian Rail Line, and that allows our teams to get in and out of site with absolute ease. And as you can see here, there's a number of other lithium projects in and around our area. It has been described by others as a real lithium hotspot, and there's 3 other JORC compliant lithium resources nearby Manna. We've been very active in building our land holding in around the Manna Lithium Project. As you can see from the diagram on the right there, it shows you our tenemency owned in green, and the project site basically in the middle of our tenemency. We've been defending that tenemency quite rigorously, but we've also made some changes, and we've grown our land holding now both on a direct and indirect basis by approximately 280% since a similar time last year. So we've now got a land holding which includes the strategic alliance with Kairos Minerals to the south of more than 700 kilometres squared. So that's a great result for us, and that is, as I said, is very strategic. You will see the benefits of that particular relationship play out in the years to come. The diagram on the left here just shows you some of the drilling done to date. It's a terrific place to be developing a mine and drilling. It's largely a flat ecosystem. It's semi-arid desert country, so we don't have complications around water, surface water, and native title type challenges, because it's quite a harsh place. It traditionally has been quite a harsh place for both animals and humans. We have delivered some fantastic results from the Manna deposit, and this is just a bit of a summary of some of those results. You can see the diagram on the right indicating some of those terrifically high grades that I mentioned earlier. The best intercept we've had to date is a 26-metre hit at more than 1.5%, and we've got a large number of these stacked pegmatites which run in parallel. You can see there the ore body is still open in multiple directions, and that will be the focus of our exploration campaign this year. We have a campaign that will kick off late Q2, Q3, which will chase some underground pegmatite system, a new discovery, in fact, to the south of the existing deposit. The strike length now is more than 3.2 kilometres and growing, and we've drilled lithium mineralisation to a vertical depth of around 450 metres. So a terrific asset, and importantly, high grades, low gangue mineralisation. So I'll talk about the metallurgy shortly, but from a metallurgical perspective, this is an ore body that can produce a wonderfully high-grade saleable spodumene concentrate. So talking about the 3 core zones, and you can see the central zone here, again, just showing some of the infill drilling results from our drilling campaign last year. Very consistent grades, sort of between 1.3 and close to 1.6%. We've found that very consistent at reasonably shallow intercept. So this will form the main pit. We are looking at further optimisation. We expect with the mineralisation to the north, probably the current mine scheduling is guiding us on an open pit for the first large number of years of mining, and then we'll look to pivot and go underground and chase these very high grades again on the northeast extension. You can see the grades here and the depth here. So this lends itself wonderfully well to potential underground mining operations. So we'll likely have a combination of open pit and underground, sharp focus on obviously the strip ratio and ensuring that the strip is a competitive one for us. And that is the focus of our DFS team currently. Importantly, though, we have this new zone that we've only really put a few holes in to the south, but it does have the potential for a new discovery. We think we will focus our drilling this year, step out exploration to the south, chasing pegmatites, and we think there's some large pegmatites to the south, and that'll be the focus of our team's exploration this year, along with some additional extensional drilling to the north. So the three main zones to this ore body, but again, we feel we've only really scratched the surface in terms of its exploration upside. A verified geological model, as I said, this shows the lithium mineralisation in the central pit here. Again, the green is the indicated ore body, the blue is the inferred. We'll continue to increase the geological confidence of our exploration for additional drilling and moving a larger percentage of the currently inferred position into the indicated position. The team's done a phenomenal amount of work as part of the DFS, and again, we're looking to optimise that DFS throughout the course of this year prior to announcing in the second half. As I mentioned earlier, there is an opportunity to look at an underground component to this to further improve the economics. So we have initiated a concept study which looks at a number of different scenarios. This will look at a combination of open pit and underground on a standalone basis. So we'll be delivering this in combination with the DFS for the Manna Lithium project throughout the course of this year as well. I mentioned the DFS is well advanced. That puts us in a great position that when that market rebounds, we'll be one of the few projects on a global basis that is de-risked and ready to go. And that's been a really important mandate for the company. Whilst we're certainly protecting our balance sheet and our core team, we're also progressing our projects because we know the market will rebound. As I said, I've seen 2 cycles previously. For lithium, I know what's ahead, and I've got very deep relationships with the downstream on a global basis, and the interest from the downstream is really continuing unabated in spite of the current spot price environment. The metallurgical work we've done is really impressive. We've achieved some incredibly high grades. We will adopt a whole of ore flotation circuit. It's the only way to truly maximise your recoveries. Importantly, we will have dry stack tails as well, so we've got a real sharp focus on water management. But we are expecting to announce some additional metallurgical test results. We've done more than 31 individual flotation tests now. So we've got a high degree of confidence around how this mineralisation will beneficiate into a saleable concentrate. And you can see the zone 1 grade recovery there of plus 6%, indicating very high recovery. So the balance for us is we don't need a 6% con, so we can further improve the recoveries and produce a 5.5% con. So that is the focus of our DFS and our metallurgical test campaign currently. Approvals and permitting is critical, and we've put a massive focus into this team in particular, progressing firstly the environmental approvals. I mentioned earlier, the Eastern Goldfields is a great place to be progressing approvals because it's far less challenging than, for example, parts of the Pilbara and the Gascoyne. So all our flora and fauna surveys have been completed, and there's been no significant impacts identified, and certainly no priority 1 species identified. The second core approval for us is our native title and heritage. We have completed all heritage surveys throughout the mining lease application area, and certainly no culturally significant sites have been identified. So again, puts us in a great position to progress the NTMA. It's well advanced in terms of that negotiation, and we are certainly on track to have that concluded this half, and that will pave the way for the mining lease to be granted soon thereafter. So the mining lease was lodged in April of last year, and we, as I said, we're just waiting on the NTMA to be executed, and then within a few months, we're expecting the mining lease to be granted. So again, if you put that in context of the market, when that market does rebound in the second half, we'll be one of the few companies globally that's got a mining lease that allows us to get started with our project in a matter of months. So finishing off then, at least in terms of Manna, the key point here is we're de-risked and disciplined. 36 million in the bank allows us to really progress our project. Most of the heavy lifting has been done in terms of spend. That was all done last year in terms of the drill out, the metallurgical test results. So this year is really an extended reporting season for us at low cost. So we will be announcing our drilling results from last year, the entirety of our drilling results. Our met test results will come to market in the second quarter. We are expecting our mineral resource update to be announced in the second quarter. Environmental native title approvals will come in the next couple of quarters. And of course, I mentioned the mining lease. So lots of really positive news flow. As I said, we've got that core team that allows us to progress these key work streams. And then we do have some additional step-out drilling that will be undertaken in Q3 this year. And of course, the DFS optimization continues. And that customer offtake partnering discussion also continues. We're in no rush to agree offtake. Offtake, as I've said publicly on many occasions, is absolutely our weapon. You're not going to give it away. But we're working with very collaboratively with a number of parties who have very strong interest in the company, given the credentials of our team to be able to execute, but also the quality of the project and the location of the project. I'd like to touch on Marble Bar. This is our land bank. Marble Bar is an 18 million tonne resource at 1%. This was the company floated with this asset back in 2021. Again, great jurisdiction, but our focus at the moment is on progressing Manna. We will absolutely turn our attention to the Marble Bar Lithium Project in the coming years, but in my personal opinion, the value of this asset is only going to increase over time. 160 kilometres from the Port of Port Hedland. It's a very large land holding, about 4 times larger than our land holding at Manna. And we've only really scratched the surface, we feel, in terms of the potential of this particular asset and the land holding. We have met our minimum spend here. It's an infrastructure-rich location. There's some other wonderful lithium projects in and around our Marble Bar Lithium Project, the Pilgangoora, the Wodgina deposits. So we will look to develop this asset in the coming years. And I talked earlier about having that development optionality. We'll look to stage and roll out a project development team onto this asset probably next year. Community is important. We've spent a lot of time in the community. We've got some wonderful relationships across the Pilbara and of course the Eastern Goldfields and work incredibly well with all of our stakeholders. So that's a wrap for me. Thank you for dialing in and look forward to the Q&A session.
Thank you, Ron. Now onto the Q&A session, as you mentioned. But before we start, just a quick reminder for everybody, if you would like to ask a question directly to the company, please do so in the Q&A panel within Zoom. We have received a few questions already. The first one is for you, Ron. How would you compare the current downturn in the lithium market to what you have previously experienced in your career, including what are the main similarities and differences this time around?
Yeah, that's a great question. I actually get, not unsurprisingly, I do get asked a lot that question. I think what's different this time around, Ben, again, you're right. I was there in 2014. I was there in 2018. The cycle is typically a 2-year bear. And if you think about it, lithium prices peaked in the fourth quarter of 2022. So we've actually been in bear market now in terms of lithium pricing, de-escalating since December of 2022 when we had the all-time highs. And I'll talk specifically here about spodumene. And what we've seen throughout the course of this last year was a step down in pricing, obviously accelerated more towards the back end, but there was quite a significant adjustment to the procurement strategy in China. Now, typically, throughout the value chain, whether that's raw materials, spodumene, the chemical side of the business, cathode or battery, is normally 2 to 3 to 4 month inventory build. But as working capital was stretched, that really flipped that model of purchasing or procurement flipped to really a hand-to-mouth basis, shipment-to-shipment basis. But importantly, what's most different about previous cycles, and particularly 2018, the buyers are still buying. They're not reneging on contracts. So that's a really, really important difference. I think back in 2018, a lot of the sellers had their backs to the wall. That's not the case this time around. But importantly, it's just a question of price now. So I've got a view that we've come through the floor. Absolutely. If you think about the floor back in 2018, it was probably a $350 spodumene price. And I think we're at 850, 900 now. So the cost curve's gone up for most of the players. And that's really indicated by where we're sitting. We've been sort of flatlining now for a couple of weeks in terms of the spodumene pricing, which to me gives me a lot of confidence. We've probably come through the floor. And just as we did back in 2022, the spodumene price probably overshot. And I think we're probably undershot a little bit on the downside here as well. So you're going to see more discipline already. We've seen a number of announcements from the incumbents, a bit of pullback. I think what you're going to find is a number of the developers, early stage explorers, are going to pull back on exploration. So that only really stretches the lucky band. So when the market does rebound, it's going to take a while for some of these companies to get going again. So yeah, some quite obvious differences this time around.
Great, thanks for that interesting response, Ron. Hopefully correct that we are through the floor there. The next question is around the metallurgy. So what is driving Global Lithium to target the 5.5% grades rather than the 6%? Is it the impurity or lower recovery that is causing it to lower the content? And what will be the discount for 5.5% compared to 6%?
Yeah, that's an easy question to answer. The market doesn't need 6%, quite frankly. As I said, that relationship we've had with Camax and others, obviously, 5.5 is sufficient for the conversion into various chemicals. There's always a sweet spot on your grade conversion in terms of your metallurgy. So obviously we can push and make a 6% product, but our focus is on more tons. So we can lower the grade and produce more product ultimately. We can certainly produce a 6% product, but it means our total production will be lower. But our focus is on solid tons. So, you know, our current design capacity is sort of more than 200,000 tons on a standalone basis for a spodumene concentrate grading at 5.5%. So it's, yeah, that's in essence the reason. And also there's only really one company that's able to consistently produce a 6% product, batch to batch to batch, and that's Talison Lithium. And that's really based on the very high head grade. They've got a +2% head grade that allows them to do that. So you will see in all the public reporting from all the other producers, it's a 5.5% or lower lithium grade in the concentrate.
Great, thanks for that answer. The next question is also around the lithium market environment, and you did touch on some of this in your previous answer, but can you please comment on the lithium price movements and the status of high-cost Chinese lepidolite production?
Yeah, it's a good one. I think, look, not unsurprisingly, when you had a spodumene spot price of $8,000 a ton, that encouraged everyone to get into operation. That was a very significant carrot. And what we found was a lot of the Chinese players would come to Australia and looking for material. Of course, most of the product was sold out. It was locked under offtake agreements. So there was just no ability for the Chinese to be able to source additional spodumene units. So, you know, they really had to go and develop their own resources in China. And unfortunately, a number of those resources, particularly the lepidolite, very low grade. You know, those grades are typically somewhere between 0.2% on the low end and 0.4% on the high end, 0.4% lithium oxide, which is very low grade compared to spodumene concentrate. The other challenge with lepidolite is the processability. You need more units to be able to produce a concentrate for the chemical. But also it has some isotopes which are challenging in terms of dealing with the waste streams. So spodumene concentrate, for the benefit of your listeners who may not know, once you convert it using a sulfuric acid to produce a lithium carbonate or lithium hydroxide unit, you produce, the main waste stream is a aciditized alumina silicate. So it's basically the spodumene concentrate minus the lithium. Now, there's various end uses for this material in China and other regions, particularly in the construction industry, bricks, cement, road base. But with the lepidolite, once you convert it, there are some elements within that residue which make it problematic. So it is higher cost. It's higher cost firstly to produce because of the very low grade. It's quite simple. But the second challenge, which will emerge, I feel, in due course, is how to manage that residue. At the moment, there's quite significant stockpiles of this material in China, but unfortunately, you can't just waste fill it, and it doesn't necessarily have an end market. So that will be an emerging challenge, and clearly that will have an impact on the total cost.
Okay, thank you. And further to your comments around offtake agreements, what would you like an offtake agreement to look like? And has the recent downturn moved the power to the buyer in this regard?
That's a good question. The perfect offtake. Look, I've been doing offtake in lithium for 12 years now, so I like to think I've got a reasonable expectation of what the perfect agreement looks like. But look, my view around offtake and partnering is it needs to be a win-win. I think in previous cycles, the offtake agreements, the way they've been structured is there's always a winner and a loser depending on where the market price is sitting. I think you need flexibility in terms of how you look at pricing. Clearly, market pricing is important. You want the exposure on the market, but you need some downside protection as well, and that helps you to fund your project. So, floor prices are going to be important, but there's also mechanisms to look at floor prices to give the buyer flexibility in case the price doesn't move below a floor. So I think that's specific intellectual property within our company. I won't sort of convey that during this call, but other things we're looking for, clearly, a partnership approach requires an off-taker to participate in funding the project by way of a prepay. And there's capital prepays. It's a debt instrument effectively, but certainly we're not giving our lithium away. There is an expectation that our partners will help work with us and help fund the project by way of a prepay. And these are significant. They're not tens of millions of dollars. They're hundreds of millions for a percentage of the offtake. So those are some things that I think are really important, but ultimately it needs to be a partnership consideration. These are long-term deals, and they need to account for volatility in the market. Well, let's face it, the lithium industry, it's still very much in its infancy. There's very little sophistication around pricing, global pricing, so that's creating a lot of the ambiguity and uncertainty, and clearly nervousness on the investment community side. But look, the energy transition is going to take decades to play out, and the parties we're talking to have a very long-term view on the market. They're not concerned with the current spot price. They're more concerned where the price is going to be 5, 6, 10 years from now. And if anything, to answer the second part of your question, is the power moving away from the raw material producers? I think if anything, the current sentiment is making it more challenging for the downstream, because they're seeing pullback from the incumbents. They're seeing a number of the juniors, explorers who are going to preserve their cash. They're not going to explore. They're not going to spend millions of dollars on metallurgical test programs and DFS programs. So, as I said earlier, that probably only stretches the elastic band that when the market does recover, pricing is likely to run pretty hard.
Sure, thank you for that answer. A couple more questions. So Global Lithium has reported it would consider its expenditure plans in response to the market conditions. How do you expect this will impact timing around upcoming milestones that the company is working towards?
Yeah, we've got our CFO on the line, so I'll let Matt comment a little bit. But in essence, look, we like all companies in the sector, are being very prudent. We've got an experienced team, and we've been through these cycles previously. So clearly, our two objectives are to protect the balance sheet, but also to progress the project and ensure we've got a core team that's ready to go when that market rebounds. But Matt, I might ask you to expand a little bit on that one.
Yeah, sure. Thanks, Ron. Yeah, look, exactly right. As Ron said, we've got a strong balance sheet. We're in no hurry to go ahead and accelerate things. We're conscious that the market this year is probably going to be in a flat period for most of this year. So our objective this year, having really been through a very, very large drilling program last year, having been through a very major piece of work on the metallurgy studies, the ore sorting trials, and the DFS preparation, we're really now into what we're describing as a reporting period. So what you'll see from us during this year is a lot of the output from last year's activities in terms of the drilling results, the metallurgy results, the progress on the permitting and approvals, and ultimately leading us to the DFS. Now, what we are doing is looking at how we best optimize the project with the information that we've got. And our objective is to ensure that our project is competitive financially when we move it through both the construction and operation phases. And that's going to position us really well with both our offtake partners and financiers for a project that's going to be a long-lived resource development here. So that's a really important step for us to get through. We have opportunities to minimise our spend. We'll keep our burn rate under a manageable level, but we certainly don't want to be back in the equity markets during 2024 raising new equity. We see the share price at this point as being undervaluing the work that we've achieved to date on both Manna and Marble Bar, and we want to see a good reflection of that asset value in our share price. So we'll take our time, manage our spend, manage our team, and we'll keep reporting the results of that activity through to the market during 2024.
Thank you, Matt. The next question is around development. So when assessing development options, Ron, you mentioned optimising the open pit strip ratio against underground development. What do you see as a competitive strip ratio for the open pit? And just second part of that question, what do you need to see to gain confidence in the commerciality of underground options?
Yeah, well, again, your ore body will dictate and give you the answer to all of that, particularly the cut-off from open pit to underground. So we're using the Whittle optimization mining model, which basically chases the most economic block units within the ore body. We're still working through the mine schedule itself. It will be reviewed by SRK, so I won't comment specifically on what the sweet spot is, because we still don't have an answer to that yet. It's still being reviewed internally. But clearly, strip ratio will govern the economics of your project, because your mining costs are your biggest costs within your OPEX. So that is a very sharp focus for us as a company. We've got some very experienced mine engineering and metallurgical capability within the team. So, and importantly, we've drilled more than 12 tonne of core for our MET program. So we've got a very good geological understanding of the ore body. In terms of, firstly, the spodumene zonation, the grading, but also, the dipping of the pegmatites, the angle of the pegmatites, which ultimately will govern how we mine this ore body, and where the sweet spot is between sort of open pit versus underground. So, but we're lucky, because we've got this north extension opening up. So, talking to our project development team, it looks quite clear to us that we'll open pit for a period of time, and then we'll have the accessibility without the huge sort of initial capex to run portals and pivot underground at a point in the future. So that's still being worked through, but certainly that will be one of the key outcomes we'll deliver as part of the DFS this year.
Okay, thank you, Ron. So the questions keep coming in. We've got time for, I'd say, one more. What is your outlook on lithium-ion-based EV demand? There have been reports of poor charging infrastructure, EV batteries failing in cold weather, battery hazards, replacement costs, and insurance, etc. Do you see this potentially slowing EV demand growth in the coming years as buyers look to petrol or hybrid as more reliable options?
Yeah, it's another good question. No, I don't. I think I've met most of the OEMs. I'm engaged with them quite significantly through my role at the LME. Lithium ion, has been around for 30 years. It's not a Johnny-come-lately, and it's been optimized. There's more to come in terms of its performance and its optimization. What I will say about lithium ion as well, the OEMs, they do value performance and cost, but above anything, they value safety. So if there is, I'm less concerned about substitutability of lithium ion, because any new technology is going to have to go through a similar development cycle that lithium ion's been through. And I said it's been 30 years. We've been deploying lithium ion batteries through our life. I think most people I read a report, the average adult owns at least 2 or 3 lithium-ion powered devices. So that will only increase over time. But again, the thing that probably gives me the most confidence, you touched on infrastructure. I would actually argue electricity is everywhere. And this is the big benefit of lithium ion, right? Electricity is everywhere. To be able to tap in an electricity source, all you need is your average electrician, a normal electrician. You don't need to have some specific bespoke Tesla electrician installing charging infrastructure for you. It costs about $150 an hour, and you can have a charging station built anywhere. So whilst people talk about infrastructure being a challenge, I think we're talking about the physical units being deployed. But in terms of the challenges in terms of getting that infrastructure in place, it's not a big challenge at all. And I've seen it here in West Perth, where our office is. There's charging infrastructure everywhere. So less of a challenge there. I think that's where I think some of the competing technologies, hydrogen fuel cell, for example, gets talked about. Well, I can say building hydrogen fuel stations is not cheap, and it won't be easy from a safety perspective either, and permitting perspective. And then in terms of penetration, look, the thing that probably gives me the greatest confidence is, let's look at the next wave of consumers. They're more technologically advanced than perhaps myself, I was as a consumer growing up. And my view is the next wave of consumers will decide, and EVs are more than just, you know, transportation devices to get from A to B. They are pieces of technology. So I'm more optimistic than pessimistic on that side of things. As I said earlier, energy transitions don't play out overnight. They take decades, just as the oil energy transition took decades to emerge and grow on a global basis. And then you need to also look at the decarbonisation thematic. I mean, the world is not just going to give up on decarbonisation. There's going to be further incentives, I feel, on a global basis. We've seen the IRA. We think in the May budget here in Australia, there's going to be some further incentive to support the industry. And of course, in Europe and Japan and Korea, China, there's lots of incentives there as well. So that's not a concern for me.
Okay. So when will the mining lease be granted at Manna? That's an easy one that's just come in.
Yeah, that's easy one to answer. Basically, as soon as the native title mining agreement, the NTMA, is executed, we would expect the mining lease to be granted within 8 weeks.
Sure. And definitely the final question now, probably one for you, Matt. Worst case scenario, how many quarters of capital does Global Lithium have to ride out the market slump before the need to raise capital through investment or loans?
Look, yeah, we can manage our burn rate down quite low. We can get our burn rate down under probably 2 million a quarter, pretty comfortably, and maintain a core competency and progress on the project. So that gives us quite a long runway here. More importantly, as Ron highlighted earlier, we've got 100% equity in our projects with no royalties. So we have a range of options available to us to progress both projects, both Manna and Marble Bar. We're in no hurry to transact both on the offtake level or on the funding level, because that is, to be frank, our key competitive advantage right now, is holding that equity for the recovery phase. As I highlighted earlier, we think our share price doesn't reflect the value of the assets and the progress we've made in the nearly 3 years since we IPO'd the company. And we want to see that reflected before we do transact on either the offtake or the funding side of the equation.
Great, thanks, Matt. So we'll have to finish up there. So Ron and Matt, or myself, will endeavour to answer any further questions that have been asked during this webinar. But thank you to Ron and Matt. I think that was a fantastic presentation, and it really shows that Manna is shaping up as a world-class project and one to watch in the years to come. Before we go, any final remarks from either Ron or Matt?
Yeah, no, keep following the story. There's lots of good news to come, and as I said, when there's a downturn in the market, there's also plenty of opportunities, and we've got our eye on opportunities.
Okay, thank you, Ron, and thank you for everybody for joining us today and being part of this webinar presentation. If you'd like to watch it again, we will send out a copy to everybody later today or this week. Thank you very much.
Thank you.